So the topic is on investments. Our concern here will be on determining the amount that will be reported as balances for your investments. Do you have a copy of the handout? It should have been shared to you by okay. Who does not have a copy of the handout? Okay, let's proceed with question number one. In year 20X9, the company purchased 30% of the outstanding common stock of the investing company for 500,000. During 20X9, the investor earned 1 million in net income and the investee earned 100,000 in net income. In addition, CAF declared 160,000 in dividends and DFG declared 20,000 in dividends. What value will CAF's investment in DFG be carried out on the end of 20X9 balance sheet? So the scenario here, class, is an example of an investment in associate. So you should have an idea already when will an investing corporation become an associate. Okay, so the scenario here is one corporation invests in another corporation. One corporation, the investor, becomes a shareholder of another corporation, the investee. Okay, in other words, the investor will be part owner of the investee. Okay, but not all instances of a company owning a part of another company will the relationship be considered as that of an associate. Okay, so first theory you have to remember here is an associate relationship will arise if the shareholdings of the investor will reach up to what point? 20% or more. So if the investor company will own at least 20% of another company, there is a presumption that the investing corporation will be an associate of the investor. Okay, but the primary test here is not really the percentage class. The primary test here is the presence or absence of SC. What does SC stand for? Sorry, SI. Significant influence. So if the problem tells you that there is significant influence, then you will have to treat the investee as an associate of the investor. But what would be the commonly used indicator of an existence of a significant influence? If the shareholdings of the investor reaches 20%. Okay? But it's not unlimited class. It should be 20% to 50%. The relationship would be that of an associate if the shareholdings or the ownership interest of the investor is between 20%, is from 20% to 50%. Because what will happen if your shareholdings, what will happen if the investor's ownership interest goes beyond 50%? The relationship will no longer be described as that of an associate, but the investee will now be considered as starts with letter S, subsidiary. Okay? So if we're dealing with investments in associates, the ownership interest must be from 20% to 50%. But again, the primary test here is the presence or absence of significant influence. We will no longer treat the investment as an investment in associate if it exceeds 50%, because if your ownership interest exceeds 50%, you do not just have significant influence, you actually have, starts with letter C, control already. Okay, so if your ownership interest is more than 50%, then you do not just have significant influence, you actually have control. So which one is higher, man, as to influence, no, as to degree of uh, what would be another term of the words would either be influence or control. But which one is stronger? Let's just use that one. Which one is stronger? Influence or control? Control. Okay. So if it goes beyond 50%, you do not just have influence anymore. You actually have control over the investing. Okay, because you own more than the majority if you own more than 50%. But again, the focus in this problem is on investments in associate. Okay. And what have we learned? If it is an investment in associate, the investment is accounted for using the blank method. Starts with letter E, equity method. And what does it mean if you use the equity method? The balance of the investment will fluctuate depending upon the changes or depending upon the effects of the operations of the investing. Okay, what's the alternative for equity method? If you do not use the equity method, you do not also use consolidation for parent and subsidiary. If you own less than 20%, what method would likely be used? You will be using, starts with letter C, cost model or the cost method. Okay, and which one is easier, the cost model or the equity model? Cost model, because under the cost model, no fluctuations to the balance of your investment. Okay, if you acquired it at, let's say in this problem, you acquired it at 550,000, unless if there are liquidating dividends, unless if the investment is impaired, the balance of your investment will remain 550,000. Okay, so we like the cost model better because it is a lot simpler. Okay, under the equity model, you would expect the balance of the investment to change. It can go up, it can go down. Okay, other than additional investments and liquidating dividends, you expect the balance of the investment under the equity model to fluctuate. What would be the sources of the fluctuations? You go back to your basic accounting class. Okay, you go back to your equity section of your balance sheet. What are the four transactions that will affect your equity account? Four transactions that will affect your equity account. Obviously, the first one is, let's start with the increases. Go back to your basic accounting. What's the equity account in your basic accounting for sole proprietorships? Okay, you simply use the owner's equity account. When does the owner's equity account increase? The very first transaction that you will journalize in your basic accounting, what's the first transaction? The owner makes an investment. Okay, so if you make an investment, every time you make an investment, your investment account will obviously increase. Okay, if it increases with an investment, what do you think would cause it to decrease for your sole proprietorships? Okay, you have your drawings or your withdrawals. Okay, but here for corporations investing in another corporation class, the withdrawals here will come in the form of receiving dividends. What happens in your sole proprietorship? What happens if you have withdrawals? You are getting an asset from the business. Can you still remember your basic accounting? What happens? What's the most common example of withdrawals class? The one that is used in your sole proprietorship problems. What kind of withdrawals? Cash withdrawals. But can withdrawals be in other forms of asset? Yes. If you take inventory from the company, that will also be considered as a withdrawal. So anytime the owner takes an asset from the company class, it will be treated as a withdrawal. It's the same here for an investment in associate. Anytime, it's not really taking this time. Anytime you receive an asset from the investee, we will treat that as a withdrawal. Okay, and when do we normally receive an asset from the investee? If we are a shareholder, when do we normally receive an asset from the investing corporation? When the investee declares dividends. If the investee declares cash dividends, we will receive what? Obviously, we receive what? Cash. If the investee declares cash dividends, we will receive cash. So when every time we receive cash from the investee, we will treat that as a withdrawal. And again, what's the effect of withdrawal to your investment account? Decrease. So what does that mean? If we receive cash dividends under the equity method, we will also decrease the investment account. So every time we talk about the equity method class, just think of your owner's equity account. It increases with investment, decreases with withdrawals. Okay? Aside from cash, is it possible for us to receive another form of asset from the investing corporation? If we are a shareholder of another corporation, is it possible for us to receive an asset other than cash? Yes. When does that happen? Again, if the investee declares dividends. But what kind of dividends? If we're talking about receiving an asset other than cash, what kind of dividend are we talking about? We're talking about, starts with letter P. Letter P followed by R. What kind of dividends? You have your property dividends. Anytime you receive an asset from the investee other than cash, that is accounted for as a property dividend. But on the part of the investor, we will just treat it as a withdrawal class. Again, anytime we receive something from the investee, treat it as a withdrawal. And what do we mean by treating it as a withdrawal? We will treat it as a deduction or a reduction to your investment account. Okay? But going back, what are the 4 transactions that will affect your owner's equity account? We've identified 2 already, investments and withdrawals. But instead of withdrawals, we actually have dividends. Okay, but I hope you get uh, the logic behind class. In withdrawals, what happens? We take an asset from the company. In dividends, what happens? We receive an asset from the company, which can be cash or some other asset. So aside from investments and withdrawals or dividends, what else will affect your owner's equity account? When do you increase your capital account for your sole proprietorships? Or P, profit. Every time the company owns a profit or a net income, what do? We close the income to the capital account. What's the entry in your basic accounting? When you close the income summary to the capital, debit, income summary, and credit, capital account. And what does that entry do to your capital account? Increase. And that will be the same also for your investments under the equity method. Every time the investee earns a profit, you will also increase your investment account. Why? Because you are the owner of the investing corporation. If the investee earns a profit, that means you also earn a profit. But this time, how is an investment in associate different from your sole proprietorships? The amount of profit that you will recognize, the amount of profit that you will add to your investment account will not be the total income of the investee. Okay? For example, sole proprietorship. The sole proprietorship business earned a profit of 1 million. How much are you going to close to the capital account? You will close the entire 1 million. But if we're dealing with an associate class, and let's say, for example, you only own 20%, should you also recognize the entire 1 million if you only own 20% of the business? The answer is no. If you only own 20% of the business, what is your right over the income of the investee? Your right is proportionally to your ownership interest. And how much is your ownership interest? 20%. So how much then should you recognize as income? How much then should you add to your investment in associate account? Only your share in the 1 million. I hope that makes sense to you. Why is it in sole proprietorship? We close the entire profit to the capital account. Because in a sole proprietorship, you are the only owner. You are entitled to the 100% of the profit of the business. But if you have invested only 20%, what does that mean? Somebody else owns the other 80%. And do they have rights also do they also have a claim over the profit of the investee? Yes. Okay, so what's my point? You increase the investment in associate account every time the investee has a profit, but the amount of increase, the amount that you will add to your investment account should not be the entire profit of the investee, but only in your share. Okay, I hope that makes sense to you. So we have identified three already: investments, withdrawals or dividends. Third is profit, but not just profit, share in profit. Okay, what do you think is the fourth one? Just the opposite of the third. What was the third one? Profit. What's the fourth one? If the investee suffers a loss, you will also record a loss. And if there's a loss class, what is the effect of a loss to your capital account? Increase or decrease? Decrease. So, if the investee suffers a loss, you will record that loss by decreasing your investment account. Okay? But again, are you going to recognize the entire amount of loss of the investee? No, because if you're only a part owner, you do not shoulder the entire amount of loss. If you only own 20%, then your share in the loss would only be 20%. Okay? So again, what are the four transactions that will affect the balance of your investment in associate account? Number one, investments. Number two, withdrawals, which will be in the form of dividends. Number three, share in profit. And number four, share in loss. Okay, but can all these four happen at the same time in the same reporting period? No, you cannot have profit and loss at the same time. So four possible transactions will affect your investment, but at most, the most number of transactions that can happen in one reporting period would be three lang. You can have investment, you can have withdrawals or dividends at the same time. Okay? Then together with these two, you can also have either profit or loss. Okay, so it should not be when you discuss investment in associate in your financial accounting class. Some of you found it difficult, but really, you are just going back to your basic accounting. You're just going back to your sole proprietorship, wherein your capital increases with investments and profit and decreases with losses and withdrawals. Here, the equivalent is your investment in associate account. If you use the equity method, investment in associate account will increase every time you make the investment and every time the investee reports a profit. Inversely, it will decrease every time you receive dividends as a return of your investment and every time the investee reports a loss. The primary difference lang, in your sole proprietorship, everything is at 100%. But in investment in associate, it should make sense to you why you will not recognize the profits and losses and even the dividends at 100% because you're only a part owner. That's just the challenge here. Okay? And the problems for the CMA examples is even simpler than the one we have for your standards. The problems will not include over or under valuation of the assets of the investee. Okay? Many difficult problems in your financial accounting classes revolve around over and under valuation of the assets, but that will not be an issue for your uh, CMA exam under this topic. Okay? So with that discussion class, I believe you can answer already the first problem. You're asked how much will be the balance. So you just monitor the transactions that will affect the investment in associate account. Okay? First sentence, the company purchased 30% of the outstanding common stock of the company. What kind of transaction is this one? What are we doing in this transaction? We are making an investment. Okay? So this will be treated as an investment transaction. And again, what does an investment transaction do to your investment account? Increase or decrease? Increase or decrease? Increase. So from 0, we will now have 550. Next sentence. CAF earned 1 million in net income. Di ba we talked about profit or net income? But whose income is this 1 million, class? Whose income is this one? The investor or the investee? Investor. Whose income are we supposed to incorporate in the investment account? Whose income are we going to add to our investment account? The income of the investor or the investee? Investee. So, in solving for the balance of the investment account, ignore the profit of the investor, class. Okay? This would be relevant in the income statement of the investor, but if we're talking about the investment account of the investor, the relevant profit here is the profit of the investee. So ignore the 1 million. I hope that is clear to you. Okay? But the sentence goes on. DFG, who is DFG? The investor or the investee? The investee. And how much is the profit of the investee or the net income of the investee? 100,000. And what did we say to the as to the effect of the profit of the investee? Will it increase or decrease or no effect to the investment account? Increase. Do you follow? Okay. So what are we going to do? We are going to add the profit of the investee. So far we were at 550, the initial investment. Are we going to add the 100? We are going to add, but not the entire. We are going to add something, but not the entire 100. Because what did we mention earlier? You do not have the right to the entire 100,000. The 100,000 is the profit of the total profit of the investee. And who has claims over the entire profit of the investee? All its shareholders. And aside from us, are there other shareholders? Yes. How do we know? We only own 30%. So what then are we supposed to add? Just our share. If we own 30% of the company, how much then would be our share in the profit of the company? Only 30% also, which would be equivalent to 30,000. Okay? And what do we do with that 30,000? Again, add the 30,000. Okay? Add it with the initial balance of 550. Next, in addition, CAF. Again, who is CAF? Declared, he is the investor. What did he do? He declared dividends. And if we talked about dividends, class, we considered it as equivalent to withdrawals. And what do withdrawals do to your investment account? They decrease. But in our discussion earlier, whose dividends were we talking about? We were talking about dividends declared by the investor, which will result in us receiving an asset. Okay? But in these 160,000, who declared these dividends? Who paid out these dividends? It is the investor. So this will not be relevant. Okay, this will not be relevant. Okay? In solving for the investment balance, whose dividend declarations and payments would be relevant? That of the investee. Okay, so ignore the 160,000. Okay, continue. DFG declared 20,000 dividends. Is this relevant? Yes, because this is the dividends of the investee. And who will receive these dividends? The shareholders of the investee. Are we a shareholder of the investee? Yes. And how do we treat the dividends that we will receive? We will treat it as a return of our investment. And if there's a return of investment, we will treat that as a withdrawal. And what is the effect of withdrawal to your investment account? Increase or decrease? Decrease. But are we supposed to deduct the entire 20,000 plus? No, because we did not receive the entire 20,000. The 20,000 here is the total dividends that will be distributed to all the shareholders. Okay, but again, we only account for 30% of the ownership in the investing. So you have to determine how much then is your share in the dividends. 30% of 20, that is 6,000. And what do we do with the 6,000? Deduct. Okay? So do that. 550 plus 30, that's 580 minus 6, that would be 574,000. And that's it. Okay? It's not really that trivial. Okay? The concept we're using here is the same concept that you have mastered already in your basic accounting. What's the difference now? If we're talking about withdrawal or dividends, it's not the entire amount. You will only be considering your share. Keyword here, class, is your share. Okay, if we're talking about profit or loss, what are we going to be including? Are we going to include the entire profits or losses or net income or net loss? No, only your share. But you would ask the question, when we discuss basic accounting for sole proprietorships, why did we not talk about share? Because there's no share to speak of. Because in a sole proprietorship, how many owners do you have, man? Only one. You could have talked about share class, but your share would simply be 100%. Okay? Let's proceed to the next problem. I think this would now require analysis on our part. Sweetwater Water Sports own 35% of Surfside. In 2016, Surfside recorded net income of 300,000 and paid dividends of 30,000. By the way, who is Surfside, the investor or the investee? Surfside, who is Surfside? Investee. Okay. If Sweetwater mistakenly recorded this transaction using the fair value method rather than the equity method, how will this affect the balance of the investment account, the net income, and then the retained earnings? Okay, so under the fair value method class, the investee's net income will not have any effect or impact on the investment account. Okay, so going back to equity method, what do we do when we receive, when the investee reports a profit? Okay, so the fair value model would also be an alternative to the cost model. Instead of cost, you will regularly update it to the fair value. Okay, if we try to compare this with your PFRS 9 class, what happens under the fair value model? You restate the balance of the investment to its fair value. And that's it. No more other computation. If the problem gives you the fair value, then the balance of the investment would be restated to its fair value. What if the initial investment was 500, fair value of 600? What do? Change the 500 to 600. In other words, increase it by how much? 100,000. And what do you do with the 100,000? You report it as a gain from changes in fair value. Okay, that's what will happen under the fair value model. Okay, but under the fair value model, what will you do if the investor reports a profit? Under the fair value model, what do you do if the investor reports a profit? You do nothing. Okay? If you'll be asked what entity will be prepared to recognize the profit of the investee under the fair value model, then the answer would be no entity. Okay? But if we were using the equity method class, if you were using the equity method, what would have been the entry? What would have been the entry? to record our share in the profit of the investee. Debit investment account. Okay, why are we debiting the investment account? Because again, what we do, we will increase the investment. What kind of account is an investment account? Asset, liability, equity. Investment account. Asset, liability, equity. Asset. So how do we increase an asset? Debit. So to record the share in the profit of the investee under the equity method, you debit the investment account and you credit profit share in the profit of the investing, which would be a kind of an income account or a revenue account. Okay. So again, going back, the second question is different from the first question because in this problem we are now using the fair value model. Okay. What's the difference then? Uh, Investment account, net income, and retained earnings. So under the fair value model, we will ignore the net income of the investing. Okay? And then dividends class will also have no impact on the investment account under the fair value model because under the fair value model, what do you do when you receive dividend? Let's say, for example, cash dividend. What will you do when you receive cash dividend under the fair value model? Let's go back to the equity method first. Under the equity method, what do we do when we receive dividends? We debit cash and then we credit the investment account. Because again, what's the effect of dividends class? It will decrease the investment account. So every time we receive cash dividend, the entry here will be debit cash and credit the investment account. Okay? But under the fair value model, the dividends will not have any impact on the balance of the investment. Okay, unsa lagi adon? What will be considered class in determining the balance of the investment under the fair value model? It's fair value. So we do not care about the profit or loss of the investee. We do not care. We care about the dividends class, but it will not have an impact on the investment account. Okay. So what then do we do under the fair value model if you receive cash? Are you going to prepare an entry? Yes, because you receive cash. In our comparison earlier, there's no entry for share in profit or loss, but in our share in dividends there will be an entry. Why will there be an entry? Because we receive cash. Why are we allowed not to prepare an entry for share in profit or loss? Because we're not receiving anything. Okay? But for dividends class, you will have to prepare an entry even if you are using the fair value model. Why? Because there is an asset that is affected, which is obviously your cash. The difference now is on the account to be credited. Under the equity method, we're supposed to credit the investment account. But under the fair value model, what entry or what account will be credited? You will now treat the cash not as a withdrawal, you will treat it as a source of income. So under the fair value model, every time you receive cash, it would be credited to dividend income. Okay? But go back to the question. You're asked for the effect on the investment balance. Under the fair value model, if there's dividend, is the investment balance affected? No, because we do not teach the investment. We do not touch the investment balance. Okay? So for the retained earnings, there will be difference now class depending on which one is greater, share in profit or the dividends. Plus under the equity model, when do we have an income? Under the equity model, when do we have an income? If the investee also reports a profit or income. Okay? Is there another source of income? The answer is no. We do not treat the dividend as a source of income under the equity model. Now, compare this one to the fair value model. When do we have an income? Do we have an income if the investee has an income? No. When do you have an income under the fair value model? We will have an income if we receive dividends. Because I hope you get the difference, Kasa. The source of income under the equity model would be if the investee has a profit. Okay? Even if you receive a dividend under the equity model, it will not be treated as an income, but it will be treated as a return of investment. But if we are under the fair value model, ang katong income under the equity method is no longer a source of income. So even if the investee reports a profit under the fair value model, you will not be reporting your share in the profit as an income. So what then will be the source of income under the fair value model? You will have an income if you will receive dividends. Okay. So what then will be the effect to what happened here? Recorded net income of 300,000 and paid dividends of 30. Okay. So let's try to compare class. Let's have an assumed figure. If the balance of your investment account was 1 million, initial balance was 1 million. Let's determine the balance of the investment account under the equity method. Okay, under the equity method. Let's have beginning balance of 1 million. What else will affect investment balance class? Aside from investments, what else? If we're talking about equity method, we will consider what? Our share in the profit. How much is our share in the profit? 35%. How much is the profit? 300,000. How much is 35% of 300? Is it 105? Yes. Okay. So what do we do with the 105? Plus or minus? Plus. That is if we are using the equity method. Next. What do we do with the dividends? How will we treat the dividends? As an addition or a deduction? Deduction. Do we deduct the entire 30? No, only our share. How much is our share? 35%. How much is 35% of 30,000? 10,500. What do we do with the 10,500? Deduct. Okay? Plus, we started with 1 million. Where did we get the 1 million? From nowhere. Okay, we just assume the 1 million. Can you use another amount? Yes. Okay, just to monitor the changes, class. So 1 million plus 105 minus 10,500. How much would that be? 1 million to, help me here. 1 million plus 105, 1105 minus 10,500. 1,045,500. 1,094,500. That would have been the balance of the investment account if the initial balance is 1 million and we are using the equity method. Okay. Next. We're not given with a fair value. Let's try to proceed first to the net income class. Okay. If we're using the equity method, what would be our source of income? If we're using the equity method, is it the 105 or the 10,500? 105. We will recognize the 105 as an income. Our share in the profit as income. How about the 10,500 that we receive? Will that be recognized as a profit if you're using the equity method? No. So from this transaction, if we use the equity method, we will have a profit of 105,000. What if we use the fair value method? What will be our source of income? Will the 105 be a part of our income? No. What will be a source of our income under the fair value method? Just our share in the dividends. And how much is our share in the dividends? 10,500. So the income under the equity method will be how much? 105. The income under the fair value method would be 10,500. So when you compare class, if you use the fair value method, what would be the effect on the net income? Net income would be understated. And obviously, if your net income is understated, what would be the effect on your retained earnings? It would also be understated. Okay? Now, if we use the equity method class, let's go back to the investment account. If we use the equity method, diba, we use an assumed amount of 1 million. From 1 million, it is now at 1,094,500. Meaning what happened? It increased by 94,500. What was the main source of the increase? What was the main source of the increase? Our share in profit. Okay, but if we use the fair value method, class, if we use the fair value method, are we going to account the our share in the profit, class? Are we going to recognize our share in the profit if we use the fair value method? The answer is no. So the investment account will not be increasing. But if we use the equity method, it would have increased. But since we use the fair value method, it did not increase. So what do you think would be the effect on your investment account? It would also be understated. So the answer here would be the first choice. It's understate, understate, and understate. Okay? So I hope you understand how we arrive at the answer. Okay, let's proceed to the next problem. HYU company purchased 500 company G bonds on March 1 for 1,000 per bond. When it purchased these bonds, HYU planned to hold them until maturity. It purchased 500 shares of Company L stock at 100 per share on March 5. Company L has issued 10 million shares of stock. It sold 100 shares of Company L stock on March 16 for 105. At the end of March company, the stock was selling for 106 per share, and Company G's bonds were selling for 1,040,000 per bond. How would these transactions be reflected on HYU's financial statements issued as of March 31, 20x9? Okay, so we'll have to identify the types of investments. First sentence. What kind of investment is this one? This is an investment in bonds. Okay. So if it's a held to maturity investment class, which is the nature of your investment in bonds, what do we do with the gains or losses from this investment? They will be reported in your income statement. Okay. And then second, because how did we know that they are to be held to maturity? The problem tells us that HYU plan to hold them until maturity. Okay, third sentence, it purchased 500 shares of Company L stocks at 100 per share. Okay, please compute the initial investment now. How many shares did we purchase? 500. At what price? Is it 100? 100 liters ako. The shares, 500 shares of Company L at 100 per share. How much would be the, sige, let's go back to the bonds na lang. Pila investment na to sa bonds, guys? 500 times 1,000, this would be 500,000. How about our investment in equity securities? 500 shares times 100, this would be 50,000. Okay? The question now is, do we have significant influence? Do we have control? Or do we just have minimal ownership interests? How do we determine that one? You compare it with the total number of shares. Who is the investee here, class? In the shares that we acquired, it's Company L. For the shares. Okay? How many shares did Company L issue, class, so far? 10 million. And how many shares do we have out of the 10 million? We only have 500. So do you think we have control here? Do you think we have control? No. So that means company L is not a subsidiary. Do you think we have significant influence here, class? Do you think we have a significant influence? No. We are a very minor player here. Out of 10 million, we only have 500 shares. If you convert that into percentage, class, how much would that be? 0.005% or even lower. Basta gamay kayo kag ownership interest. Okay, so this would not be treated as an investment in associate. Okay, so this would not be treated as investment in associate. Okay, so this can be treated as a, what's the intention here? We are even going to, we even sold it after a few days lang. Okay, so we can classify this as a trading security class. Okay, and if it's a trading security, any realized gain, if you sell it, will be reported in the income statement. But aside from the realized gain, any changes in the fair value, which will give rise to unrealized gains or losses, would also be reported in your income statement. Okay, so let's focus first on the shares class. How many shares did we buy, class? 500. And what did we do? Out of the 500, we sold how many, class, on March 16? 100. At what price? 105 per share. How much is 105 times 100? Is it 10,500? Okay, it's 10,500. Okay. How much was the cost again of our investment in equity securities, class? Diba it was it 50,000? And how much did we sell the 100 shares, class? 10,500. So in determining our realized, class, if you are already selling it, it will result in a realized gain, or it can result in a realized gain or loss. So how much was the selling price? 10,500. Are we in determining the loss, the gain or loss? Are we going to compare the 10,500 with the 50,000, class? No, because the 50,000 is for all the 500. So what then are we going to compare with the 10,500? Just the cost of the 100 shares. Pila man ito cost aning per share aning atong investment? It was 100. So how many shares did we sell? 100 also. So the cost then of these 100 shares is 10,000. Okay? And then, how much did we sell it for? We sold it for 10,500. So what then is the result of the transaction? A gain of 500. What kind of gain is this one? Realized or unrealized? Realized, because this is already from actual realization or sale. So our answer here could either be A, B, C, or B. It did not help us. Okay, let's proceed. What else could be the source of our unrealized gain? The changes in the fair value of the remaining. How many shares are remaining? 400. Okay, are we even with the fair value of this 400? Yes, at the end of March, these shares were selling for how much? The shares were selling for how much? 106. So how much then is the fair value? 106 times 400, that would be 42,400. Am I correct? 42,400. To what amount are we going to compare the 42,400? Are we going to compare it with the 50,000? No, you just compare it with the remaining. Plus remember that you sold already 100. Your initial investment was 50. You sold 100 with a value of 10. So the remaining value of the 400 is 40. Okay? Am I correct? Is it 40? Okay, but the fair value now is 42,400. 42,400. So what happened to the value of the investment in equity securities? Did it increase or decrease? From 40 to 42,400, did it increase or decrease? Increase by how much? 2,400. So is this a gain or a loss? Gain. But is this a realized or unrealized gain? Unrealized. Because we have not yet sold the investment. The gain here is only from the change in the fair value. Okay, so with that, our answer could now be either A or C. Okay, let's check. What is this 20,000? Uh, this should come from the bond. How much again was the value of the bond class? 500,000. But what did the problem tell us? Its fair value is at 140 per bond. How many bonds do we have? 500. 500 times 140. Is that 520,000? Is that 520,000? So there is an increase of 20,000. But are we going to recognize the increase as a change in our investment and as a source of income plus? The answer is no, because the bond is not accounted for using the fair value model. What are we going to use here? We are going to use the amortized cost. And under the amortized cost class, you ignore changes in fair value. Okay? So you ignore the changes in fair value. And if you use amortized cost. When do you use amortized cost class? If the investment in bond is held to maturity. So what do we do with the 20,000? Ignore. So the answer here would be letter A. Because if this comes out, class, you should not have any reason not to get it. I'm not saying this will come out. Next, somewhat familiar. Going back to investment in associate. Why do I say that the next problem, BNF company, is involves an investment in associate? Because we own how much? 40%, which gives us what? SI, significant influence. Okay, when can we say that we have significant influence? If we own at least 20% up to 50%. Okay, so the company purchased 40% at what price? 700. Let's do this quickly. Okay? This is just another variation of the first problem we discussed. Okay, BNF earned 2 million. Who is BNF? Investor or investee? Investor. And what are we trying to solve? The balance of the investment in associate account. So is the income of the investor relevant for the investment in associate account? Investor's income. No, so we will ignore the 2 million. Whose income is relevant? Whose income is relevant when solving for the investment in associate balance account? The income of the investee. And who is the investee? CTN. What happened to CTN? Big problem. CTN reported a loss. But what did we say? Will this make it difficult? No. If it's profit, what do we do? Add. If it's a loss, what do we do? Deduct. How much is the loss of the investee? 50. Do we deduct the entire 50? No, only our share. And how much is our share in the 50,000? 40%. How much is 40% of 50? 20,000. So what do we do with the 20,000? Deduct. Deduct from what? The 700,000 initial balance. Next, BNF declared 200,000. Who is BNF? Investor. In solving for the investment in associate balance, is the dividend declaration of the investor relevant? No. Whose dividend declaration is relevant? That of the investee. What's the effect of dividend declarations? Plus or minus? Minus. How much is the dividends declared by the investee? 15. Do we deduct the entire 15? No, only our share. How much is our share percentage-wise? 40%. How much is 40% of 15,000? 6,000. What do we do with the 6,000? Deduct. Okay, so far what do we have? 700 plus, sorry, minus 20 minus 6 will give you how much? 674. Okay? No issue there. Next, which of the following statements is correct about debt securities classified as available for sale securities? Plus, for your CMA exam, the classification would be trading securities, available for sale securities, investment in associates, and investment in subsidiary. Okay, for trading securities, use fair value model. Do the same also for your available for uh, sale securities. The answer here, class, would be the third choice. Available for sale securities are not specifically designated as held to maturity or trading securities. What does this tell us? The available for sale securities is a residual classification. Okay? If you intend to hold it for trading purposes, classify it as trading securities. If you intend to hold it for up to maturity, then it will be classified as held to maturity. But if we're talking about held to maturity, Klasa, this would only apply to your what kind of securities? Debt securities only, because equity securities do not have maturity. Okay, so if you will not classify it as trading securities or held to maturity, and it will not qualify as an associate or subsidiary, then the residual classification will be available for sale securities. Okay, let's go over the other choices. Realized gains from sale of available for sale securities are included in other comprehensive income. Plus, if it's realized already, it will not go to your OCI, but it will go to your income statement. Okay? Why will the first choice be somewhat confusing, class? Because if you're dealing with unrealized gains or losses from available for sale securities, it will be reported in OCI. So again, very important theory. Unrealized gain or losses from AFS securities, it will be reported in other comprehensive income. But if it's a realized gain, class, it is no longer in your OCI, but it will now be transferred to your income statement. Next, unrealized gains on available for sale securities are included in income. This is false because again, if it's unrealized gain from available for sale securities, it will go to your OCI or your other comprehensive income. Why will students get confused? Okay, the rule is different for trading securities. What's the rule for trading securities? All gains and losses for trading securities go to your income. Okay? Whether realized or unrealized, if it's a trading security, it goes to your income. But what's the rule for AFS security? If it's unrealized, it will still remain at your OCI. Pero what kind of gain will go to income if it involves AFS securities, if it pertains to realized? Okay, last choice, available for sale securities are carried at amortized cost. This is wrong. They are carried at fair value. Okay, next, all of the following statements about the accounting for investment in debt securities are true except go over the choices. What are we looking for? Are we looking for the true statement or the false statement? False statement. Okay, first choice, trading securities and available for sale securities are valued at current market value. This is true. Okay, class, that's why many will get confused between trading and available for sale securities because they have a lot of similarities. They are both measured at fair value. But what's the primary distinction? Treatment for treatment for unrealized gain. What's the treatment for unrealized gain for trading securities? Where is it reported? Reported as part of your income. But unrealized gain for AFS securities, where will it go? Plus unrealized gain for AFS securities, where will it go? OCI. Okay. Next, held to maturity securities are valued at amortized cost on the balance sheet. This is also true. Unrealized gains on trading securities are accounted for differently than unrealized gains on available for sale securities. This is exactly what we mentioned earlier. So this is also true. Unrealized gains on available for sale securities and held to maturity securities are recognized in the statement of comprehensive income as other comprehensive income. Why is this false? Because you do not recognize unrealized gains for held to maturity. The first part is correct. Unrealized gains for AFS securities will go to OCI, but you do not recognize unrealized gains for held to maturity securities. So the answer here is letter D, or the fourth choice. Next, because this is similar to the one we solved earlier, do you think the answer is also letter A? Indeed, it is letter A. Let's try to solve for the 60. Where do we get the 60? Realized gain. If this is the same as the earlier problem, this would come from the sale of shares, correct? Company A has issued 1 million. XYZ sold 60 shares. Okay, how many did we acquire? 100 shares of company A. And what did we do with the 100? We sold 60. An alternative way of solving for the gain class will just be getting the difference of the acquisition price and the selling price. How much was the acquisition cost for the 100 shares? It was 10 per share. How much is the selling price of the shares that we have sold? 11. So there's a difference of 1. Which one is higher, our cost or our selling price? Selling price. So we'll have a gain of 1 per share. And how many shares did we sell? 60. So we will have a total gain of 60. What kind of gain is this 60? This is already a realized gain, which should not help us because all choices have realized gain of 60. Okay, next, if this problem is the same as the other one, no, it's not the same. Because the bonds class are, we intend to sell them in the short term. So the bond is not held to maturity. So we will have to take into account the fair value of the bonds. But let's focus first on the stocks class. How many stocks are left after selling 60? 40. Okay, and how much is the fair value of these shares now? 11.25. So there's an increase of how much? There's an increase of how much? 1.25. Multiplied with 40 shares, that's 1.25 times 4. How much, class? Is it 5? Okay, so we'll have a gain of 5,000 from the shares. Is it unrealized or realized? The 5, is it unrealized or realized? That's 5 or 50? 50. 1.25 times 40 will give you 50. Is it realized or unrealized? Unrealized. Okay? So, but we have to check, plus you have to include the bonds also, huh? Did we sell any of the bonds? I think we did not. Did we? Purchase 90. We will know if our answer will not be the choices. How many bonds did we buy, class? 90, and at what price? 950. And then how much now is the fair value of these bonds? It is now at 975. I hope you're able to follow, class. Okay? From 950 it is now 975. So there's an increase of 25. And how many bonds do we have? We have 90. So 90 times 25, 2,250. That's 90 times 25. That's 2,250. Okay, so we will have a gain of 2,250. Is it realized or unrealized? Unrealized. Okay. Okay, so from the bonds we have 2,250. From the shares we will have 50. So our answer here will either be the first or the third choice. Okay? But what then are we going to do? Where are we going to report the 50? Will the 50 unrealized gain from the shares be reported in the income statement class? No, all of these will be reported in your Sorry, the 50, uh, since this would be, since these are all trading securities since these are all trading securities, all of them will be reported in your income statement. So the answer here would still be letter A. Okay? Trading securities. Why do we say that they are trading securities? What's the intention for the bonds? We intend to sell them in the short term. For the bonds, the same. We even sold it after a few days. So the answer here is letter A. Okay? But comparing this one with the earlier problem we discussed, why are we now including the bonds this time, class? In the earlier problem, the bond was held to maturity. This one it is intended to be sold. So this would be part of our trading securities. Okay? Next, which of the following statements concerning the fair value method of accounting for equity investments is correct? Okay, so we're looking for the true statement. First, an investor includes its proportionate share of an investor's net income in its own net income under the fair value method. This is false. When do we include as part of our income our share in the income of the investee? If we use what method, class? What do we have to change in letter A to make it true? Instead of fair value method, we use the equity method. Letter B, an investor includes unrealized gains on investments in income under the fair value method. This is true. So this is the answer. Okay. Next, letter C, the fair value method must be used when an investor exerts significant influence. No. If you exert significant influence, what method are you going to use? You will use equity method. Fourth, an investor accounts for the interest in a controlled investee using the fair value method. Again, that is false. If you have control, you will now be using consolidation class. You will no longer be using the fair. You will not be using the equity method. You will not be using the fair value method. Okay. So again, the answer here is letter B. Next, on May 1, Reynolds purchased 5,000 shares of common stock of Haywood and does not have significant influence. On December 31, the Haywood stock had a fair value of 257. How is the gain in investment? Will be reported. Class, if we do not have significant influence, are we going to use equity method? No, we will be using fair value model, the fair value method. Okay, what happens under the fair value method? Restate the balance to its fair value. How much was the initial balance, class? Initial balance of the investment, 250. And how much now is the fair value? 257. So what do we do? Increase the 250 to 257. And how do we record the increase? Record it as a gain or a loss? Gain. What kind of gain? Realized or unrealized? Gain, realized or unrealized? Unrealized, because we have not yet sold. But will it be reported in your income statement? The answer is yes. Okay, because the default is uh, unless it the problem tells us that it would be considered as an AFS, then it will be treated as a trading security. Okay, so the answer here is letter D. As a 7,000 gain in current earnings for the period. Next, all of the following statements about the consolidation method of accounting are true except, so what are we looking for? The true or the false statement? False, okay? Under the consolidation method of accounting, when do we use this one, class? If we already have control. The investor only includes its proportionate share of the investee's assets and liabilities. No, you will include all the assets and liabilities of the investee. So this is already the answer. The false statement is letter A. That means letter B, C, and D are true. The consolidation method of accounting is used to account for investments where the investor can exert control. Very easy, true statement. Next, under the consolidation method of accounting, only the equity of the parent appears. This is true. You just have your business combination last semester class, correct? So you're an expert in the consolidation method. But the problems for the same exam would not be the same as what you've discussed in business combination class. So, no problem. Under the consolidation method of accounting, the assets and liabilities of the subsidiary are recorded on the consolidated balance sheet at fair value at the time of purchase. This is true, subject to updated depreciated cost. Next, which of the following statements is correct concerning available for sale securities and held to maturity securities? We're looking for the correct statement. Debt securities can be classified as held to maturity only when the company has both the intent and ability to hold the securities until they mature. Okay? This is true. Please remember this one, class. This might be asked as an essay question in your pre-finals. Okay? Next, available for sale securities and held to maturity securities are carried in the balance sheet at their current market values. Again, this is false because while AFS is at market value, held to maturity will be at amortized cost. Letter C, realized gains from AFS are included in income. Realized, that's correct. While realized gains from held to maturity securities are included in OCI. That's wrong. All realized gains will be part of your income. Next, unrealized gains on available for sale securities and unrealized gains on held to maturity securities are both included in OCI. No, again, you do not have unrealized gains for held to maturity. Next, SMF. SMF class, I think you can answer this already. The answer is letter D. Or do you want to discuss? Ano? The answer here is letter D, a realized gain of 800 in the income statement, dividend revenue of 100 in the income statement, interest revenue of 85, unrealized gain of 1,800, and unrealized gain of 9,000. Next, very similar to the other problems we've solved, I think. 10 bonds, 10 1,000 bonds, sold it for 1,025. So we will have realized gain of 25 times 4. How much is 25 times 4? That would be 100. And then what else happened here? We receive interest payment of 300. So how are we going to recognize the 300? The entire 300 would be reported as interest income already because this is not held to maturity. This is using the fair value, this is classified as trading security. So the 300 here would be interest income. Next, what else happened? Change in fair value. How many bonds are left, class? We sold 4. We had 10. So how many are left? We have 6. And what happened to the fair value of these 6? It increased by how much? From 1,000, it is 1,005. So it increased by 5. So there's an increase of total of 30. What kind of gain is the 30? Realized or unrealized? Unrealized, but this will still be reported in your income because the bonds are classified as trading securities. So what are our gains here? 100 from realized gain from the sale of the bonds, 300 from interest, and then 30 from unrealized gain. Again, why is the 30 included in the net income? Because the bonds are classified as trading securities. So the answer here is 430. Next, which of the following statements is correct about debt securities classified as trading securities? We're looking for the true statement. First, realized gains on trading securities are included in income. Is this true or not? This is true. So this is already the answer. Do we have to read the other choices? No, but please do. Okay? Make sure to know why they are false. Change in market value of trading securities are included in other comprehensive income. Why is this false? Changes in market value of trading securities are part of your income. Interest revenue from trading securities is deferred until the securities are sold. No, they are already recognized as interest income. Next, trading securities can be designed as held to maturity or available for sale securities. That is false because uh, they do not have any. No, it's inconsistent. Okay, and if we're talking about uh, so if it's trading, then it's trading. Available for sale securities is a different classification. Okay, next, similar problem from the earlier one was this one. This time the classification is held to maturity. Okay, we had 40, we sold 10, so we will have realized how much was the selling price? 1,020. Class, I hope you're still following. The initial cost was 1,000. We have a gain per bond of 20. How many did we sell? We sold 10. So we will have a realized gain of 200. Okay? And then we receive interest payment of 1,200. Will this form part of our income already? Yes. Next, there is a change in fair value. Are we going to include the change in fair value? No, because the bonds are not trading securities. They are classified as held to maturity. So our answer here will be 1,400. Just the 200 and the 1,200. Next, which of the following statements is correct concerning trading? I think we've beaten this to a pulp already, class. The answer here should be letter B. Trading securities are carried in the balance sheet at current market values, while held to maturity securities are carried in the balance sheet at amortized cost. I hope you already know what makes the other choices false, class. Next problem, is this an investment in associate? Because the problem has no percentage. How do we know whether or not this is an investment in associate? Solve the percentage. How can we solve the percentage? How many did we purchase, class? 30,000. And then how many shares were outstanding from the investee? 100. So how much is our ownership interest? 30%. So will this be treated as an investment in associate? Yes. Initial investment, how much? 5 per share. How much is 5 times 30? 150. Next, Bonita has 20,000 income. Who is Bonita? Investor or investee? Investee. You might think if it's the first one mentioned, it's always the investor. So be careful. This one, Bonita, is already the investee. Is the profit of the investee relevant? Yes. What do we do with the profit? Plus or minus? Plus. Do we add the entire 20? No, only our share. Percentage wise, how much is our share? 30%. So 30% times 20, you will have 6,000. Next, Bonita also paid dividends. Is our dividends relevant, class? Yes. Plus or minus? Minus. Do we deduct the entire 4,000? No, only our share, which is 30%. And how much is 30% of 4,000? 1,200. What do we do with the 1,200? Deduct. So 150 plus, how much was it? 6 minus 2,400 will give you 154,800. Do we take into account the change in fair value, class? No, because this is not measured using the fair value model. It uses the equity method. So the answer here is, how much is the answer, class? How much was our share in the dividends? 1,200. So it's 154,800. Okay, imagine you can answer this problem in 10 seconds. Okay, what's the question? Whitlow reported their unrealized gains in the income statement as part of net income, but Tanaka did not. Why? The answer here is the second choice. Whitlow classified their debt securities as trading, whereas Tanaka classified their debt securities as AFS. Which of the following statements is correct concerning available for sale securities and trading securities? I'll just give you the answer, class. This is letter. What are we looking for? The true statement. Letter D. Unrealized gain on available for sale securities are included in OCI, while unrealized gains on trading securities are included in income. Class, we've repeated this a lot of times. You should not get this wrong. Okay? KIP company, similar to the one I told you to answer, class. So what are we going to do here? You also answer this. Okay, I'll give you the answer. The answer is letter C, the third choice. A realized loss of 400, interest revenue of 65, dividend income of 25, unrealized loss in the income statement of 2,000, unrealized gain of 5,000 in the income statement. Okay, I think at least one of these kind of questions will come out, class. So make sure to know the answer. And not just to know the answer, and how to answer it, class. Next, Morgan and Tina. Morgan and Tina are discussing the difference between debt and equity securities. Morgan says that they are essentially the same thing except that they are categorized differently in the accounting records. Tina disagrees, saying that they have different valuation approaches. Who is correct? Tina is correct because debt securities use fair value and amortized cost, whereas equity securities do not use amortized cost. Okay, so expect these kind of questions because somewhat of a question that requires decision making on your part. Is this a repeated question? So this would be understate, understate, and understate. Next, I think this is also repeated. The answer here is the second choice. Changes in market value of held to maturity securities are not included in income. The answer here, class, please answer this on your own. The answer here is the first choice. CTN's investment is recorded at 22,400 and its income increases by 2,800. I think this is the same problem as what we've solved earlier, but different question. Next, the answer here, class, will be the second choice. The investment in BAL is 132,000 and its income increases by 21,000. Next, which of the following statement concerning consolidation method? Correct. Here is letter D. An investor must record the goodwill arising from an investment under the consolidation method. A is wrong. Significant influence. It should be control. B is wrong. It's not historical cost. It should be fair value. Okay, next question. Which of the following statements concerning the equity method of accounting for equity investment is correct? Answer here is an investor's net income increases the balance. We've discussed this already. Balance of an investor, investment account under the equity method. Answer for element company is letter B, a realized gain of 360, an unrealized gain of 160, an unrealized loss of 50,000. Brendan, the answer for Brendan would be letter D. The true cost of the plant would be much higher than necessary as the stock's trading value should be considered. LOU, LOU class is letter C. LOU will record its investment at 1,200,000 on its consolidated balance sheet, prepared immediately after the acquisition. BNF, answer here would be the last choice, 760 to net income, 280 to other comprehensive income. Delgado, this would be classified as a long-term investment. Shelton, answer for Shelton would be the first choice. The decision of the CEO is correct as companies are required to issue consolidated statements only when the ownership exceeds 50%. Okay? This is not tricky, class. You should get this right if this comes up. Maxlan, the answer would be 2 or 3 only, class. Roman numeral 2 or 3 only. CVB, answer is third choice. Year X2, net income will increase for any dividends received from POI. Okay.